Greetings, everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely check out the website at cubicleinvesting.com. All right, so I want to talk about what took place in the market on Friday, particularly with the S&P 500 or the SPX, which is the index that represents the S&P 500. So what you see here is a 5-minute chart of the price action from Friday's trading session. And these black lines with the numbers on them represents what I call levels of interest. So levels of interest are levels that I determine every day that I use, and I also send to my members of my Flip That Option community. So we use these levels of interest as a reference point to place our position, our credit spread on the SPX 0 DTE options trades. So 0 DTE stands for 0 days to expiration, right? So I come up with 3 levels of interest on the call side, right? So the call side would be above the price action, and the put side is going to be below the price action. So level 1 on the put side was 66.65, level 2 was 66.40, and level 3 was 66.15. On the call side, it was 67.75, 6,800, and 68.25. Now this was on Friday, November the 7th. Now, for those who have been following me for quite some time, you know that I don't look to put on a options trade on the SPX 0 DTE until the SPX's price action has dropped 20 points below the opening price or has risen 20 points above the opening price. Because from my experience, that 20-point move above or below the opening price is a significant move. So now, as you can see here on this 5-minute chart, so the green dotted line represents 20 points above the opening price, and the red dotted line represents 20 points below the opening price. So when the market opened on Friday, as you can see here, the market immediately began to depreciate in value. And it actually went 20 points below the opening price 5 minutes after the market opened. Right, and so that was my first cue to look to put on a trade, a credit spread, sell a credit spread on the SPX 0 DTE. But I don't automatically just place the trade. I am still looking at the price action, and I'm also looking at the XLK sector, and I'll go over to the platform here in a minute to kind of give you guys more of a visual of what I'm looking at. But I look at the XLK because the XLK sector, right, is the sector that has the most influence on how the SPX moves. It has about a 36% influence on how the SPX moves. And the SPX is nothing but a representation of 11 sectors in the market, right? And the XLK sector, or the XLK ticker, represents the technology sector. And so I'm looking at, the XLK to see if it's continuing to go down, drop in value. And I'm also looking at the market internals. But nonetheless, I am looking to place my trade in the direction in which the market is moving. And so that may seem counterintuitive to a lot of folks, because you would think that, okay, well, if the market, pull up my point here, if the market is actually moving to the downside, then it would make sense to go on the call side and place your position, right? Because that would mean that your position or the price action would be moving in the opposite direction of your call credit spread. Well, that makes sense, but the way I see this is I look at money as an abstract form of energy. And so when money is being pulled out of the market, or when energy is being pulled out of the market and it causes the market to go down, I want to place my position in the direction in which the energy is moving, right? And so on Friday, I was at 66.10, 66.05. Now, this here is the lowest candle for Friday's trading session, and it was at 66.31. So I was at 66.10, so roughly 21 points away, which can be rather close, right? But because my position was sized correctly, I didn't panic. And what I've noticed is that what I have experienced in the past is that the market can start very strongly in one direction like it did on Friday. And then during the trading session, it can tend to actually reverse and trade just as strongly in the opposite direction. And so that's the reason why I like to trade. I like to place my position in a direction in which the market has made that 20-point move, right? And so because oftentimes when it reverses, your position now is in a very safe space because now the market has reversed and is moving in the opposite direction. And that's exactly what took place on Friday. So now if I refresh this chart here, because I had it, I condensed the chart so that you can see all 5 levels of interest. I'm sorry, all 3 levels of interest on the call side and put side. But when I refresh the chart, you can see a more of a true representation of the price action of SPX. Right. So as you can see here, the market opened here and immediately start to drop in price. And at 12:05, the market reversed, and it actually did. It actually went above the opening price on Friday's trading session, right? And again, I've seen this enough times to know that it's better to place your position in the direction in which the market has made a strong move, because the market sometimes has a tendency to reverse and move in the opposite direction just as strongly. And that's what happened on Friday. So had you assumed that the market was going to continue to go down or actually stay down, and you went on the call side, your position would have been threatened probably around 2 o'clock, 2:30 at this point here. Right. So, okay, so like I said, I like to, in addition to looking at my levels of interest, I also maintain visibility of the 11 sectors that make up the S&P 500. And I also have the VIX up as well. So the VIX is nothing but the fear gauge for the S&P 500. So nonetheless, I'm always keeping track of what's taking place with XLK. Because as I mentioned before, XLK has the largest influence on how the SPX moves. And so when the SPX makes a 20-point move to the above the opening price or below the opening price, I'm looking to see what's going on with XLK. Is it if the market is dropping, is XLK continuing to drop in value as well? Because I'm looking for that point of inflection where the market is going to stop, it's going to base out, it's going to find a level of support, or at least an area of support. Because when you're selling the credit spread, you don't have to be, accurate about the area in which the market is going to base out, or is going to potentially reverse in direction, if you're following me. So yeah, and so obviously, when we were looking at the previous segment of this video, the lowest point was 66.31, right? And so the market began to bounce from that point on. So I was at 66.10. And what I noticed was that when the market started to bounce, XLK started to go back up in value. So it was sort of confirmation. And I'm also looking at the market internals as well, particularly $ADD. Now you can look this up. You can do a Google search on what $ADD represents, but essentially it's looking at the number of stocks that are rising on the New York Stock Exchange minus the number of stocks that are declining. And so when that value is positive, like it was near the end of the trading session on Friday, that means that there are more stocks rising on the New York Stock Exchange versus declining. And so that will impact the price action of SPX, right? So I also look at that as well. And so, yeah, so Friday was the epitome of the reason why I'm constantly telling my members that, you know, you want to wait for that 20-point move above or below the opening price, and preferably you want to place your position in the direction in which the SPX is moving strongly, right? And you don't want to automatically place your position on the on the call side or put side. You want to look for confirmation from the XLK and also the market internals. So Friday was a pretty easy trading session for me, and also for a lot of my members, because again, you know, we are just using the market's energy against it, or as a means or reference to give us an idea of where we need to place our credit spread, whether it's gonna be on the put side or the call side. And so how do I come up with these levels of interest? Well, essentially it's relatively easy. I just look at the cost of a straddle. So a straddle, essentially you're placing, you go on the put side and also the call side, and you are placing a long option over the price of SPX on the put side as well as the call side. So you would do this by clicking on the price or the premium under the ask column on each side, right? And so that will give you a price of the straddle. So now that price, you can round that up, which would be 55. That gives you the expected move for this particular expiration date. Now, of course, this is going to change, you know, when the market opens. This cost will always change, and also it can change based upon some headline news. Some, you know, a negative headline comes out, and that could actually increase the cost of a straddle immediately. But nonetheless, this would be the expected move, right? So 55 would be the expected move. So you would add that to the price of SPX, and that would give you your level 1 on the call side. You subtract this number from the value of SPX, and that would give you your level 1 on the put side, right? 1.5 times this number added to the price of SPX will give you your level 2 on the call side. And 1.5 times this number subtracted from the value of SPX will give you your level 2 on the put side. And then 2 times this number added to the SPX gives you your level 3 on the call side. And then you subtract that number from the value of SPX, and it gives you your level 3 on the put side. So hopefully that helps. And again, what I've noticed from trading the SPX, 0 DTE, and I've been quite successful at it. Now, I don't only trade the SPX 0 DTE. You can see here I have a whole bunch of other trades on as well, right? So I also like to trade, I also like to buy deep in the money call options, you know, so been very successful with that. But when I'm trading the SPX 0 DTE, that's the strategy or the methodology that I use to find my levels of interest. And level 3 is always going to be 2 times the expected move, right? Level 3 is always going to be the level where you're going to have the highest probability of walking away with the money.